Good day, fellow investors. Inflation will likely be the game changer and the factor that shifts investing from the current paradigm of low interest rates or zero interest rates and money printing forever to higher rates, higher, perhaps real rates, less possibility for money printing, and the world where you can solve all your problems by simply pushing the money print button. Just a few very interesting comments here. Phil said steel up, oil up, copper, wheat, soybeans, homes, lumber, but inflation just 2.6%. Who are we trying to fool here? Also, mega buyer, he says that he is a little bit older and he went to buy a gallon of paint and said to the cashier that inflation is low, but the cashier still said it's $35 a gallon. And then Philip replied that inflation is measured through an average basket of goods and services, read manipulated. So I really wanted to look deeper into this topic of inflation to see also how it might impact my portfolio, what to focus, and whether I am on the right path, and also share all the knowledge about inflation in one video so that it helps you too. Please click that like button and consider subscribing if you get value from this content. We're going to discuss the current inflation, what's going on and what will likely happen. We're going to discuss the types of inflation, why the inflation target is at 2%, why not 4% or 8% or 0. Then we're going to discuss investing with inflation, and with the conclusion, I'm going to get some help from Warren Buffett and Charlie Munger, also discussing how businesses perform in inflation. Let's start with where are we now with inflation. So from JP Morgan, this nice chart, we can see how currently 2020, especially with the COVID pandemic, we are all very, very blue globally. However, in 2008, 2007, keep that in mind also when we check interest rates, especially the Fed's rate, you see a lot of red here, which means higher inflation. And then something also important is that you might not have inflation in the euro area, but you have inflation in Japan a little bit more, or Mexico, Brazil. So it is not unique globally. So also something to consider. When we look at the measured inflation, the core consumer price index, we see how it has been low, below 4% over the last 30 years, with headline inflation just spiking here and there. But let's say inflation didn't really touch in the US 3% since the 1990s. So very, very low inflation for a long period of time. And now people are complacent that it will last forever. I feel it will change sometimes, but we'll see. And as I said before, for the red inflation 2008, if this happens again, remember the commodity spikes in 2008, 2007, real estate spikes, look at what the Fed did. The Fed pushed its rate from 1% to 5% from 2003 to 2005. 5% federal funds rate, let's say 6% treasuries, you have a 50-60% stock market crash in a beat. That's what inflation might force the Fed to do. And then if they can't print, they can't save the market. We'll see what happens, but this is something to keep in mind always as an investor. Anything can happen. As said, inflation, it can be regional. Now we have the US and Europe printing like there is no tomorrow. So we might see inflation in US, Europe, a currency inflation localized with some countries or regions, and not that much inflation in other countries. That's also possible, depending on the perspective on the currency. Another factor there is wages. If you look at wages growth, on average, we are perhaps over the last 10 years around 2%, which means that if we calculate inflation at 2%, your salary didn't go up that much. Also, if we look at the declines during COVID, during the crisis, that's not much to celebrate. Also, in Europe, the situation wasn't much better with inflation, as they say, at 0 or 1, then wages growth of 2% looks like it beats inflation, but you can keep wages low, governments, etc., and nobody complains. But let me know in the comments below whether you agree that inflation is just 2%, and we'll discuss that in a moment, and whether your wages, do you feel like you can buy more with your money or not. That's the most common sense answer to whether there is inflation or not. You simply feel it on your skin, and we'll see how that might change over the next 10 years. When it comes to measures of inflation, there are three types of inflation. There is, of course, consumer price index, there is monetary inflation, and there is asset price inflation. Consumer price index, it is a measure of inflation, and it looks how much each household spends in a day, in a year. They put all that into baskets, calculate the statistical averages, and they come out with the consumer price index. That's our measure for inflation. However, let me show you this. This is just one way of measuring inflation that skews a little bit the party here. If we look at the iPhone announced in 2007 and we look at the price, it was $499 for the 8GB or 4GB version. However, if we look now at the iPhone, the price is $999, so double in, what is this, 13 years. And now you would think, okay, inflation, few percentage points per year, so there is the double in 13 years. Not a big deal, Sven. However, what if I tell you that this is not inflation? Because how they measure it, they look at the iPhone from 2007, this is my improvement, it works also with Scotch tape, so great. They look at the iPhone from 2007 and then they compare it to the current iPhone, and then they see 3 cameras versus 1, much more space. Actually, they say there has been a deflation in Apple iPhone prices because of the improved technology. So I look at it, I have to pay $1,000 for a phone. 12 years ago it was $500. They look at it, yes, but the quality is 10 times better, so actually we have deflation of 50% that we put into our basket. That's something that people forget when it comes to inflation. But it's up to you to decide whether it is deflation because of technology improvements, or it's just 500 versus 1,000 bucks out of your pocket. If we adjust this on how inflation was measured before the 1990s, then you can see this on the shadow stats inflation for the US. Inflation is practically 2 percentage points higher than the actual reported inflation from the government. Then we have monetary inflation. If there is more money, it means money is worth less, and there you have inflation. Just take a look at M2. So it was growing steady and stably alongside economic growth, but then, especially after the 2009 financial crisis, simply it exploded as the Fed started quantitative easing, and now with monetary policy free, we have had an increase of, what is this, 33% compared to last year of the monetary base. 33%. Now, of course, everybody is locked at home, no spending, but it means that the US dollar is worth much less because of this. From a monetary inflation perspective, of course. Some argue that it doesn't matter because the velocity of money is going down and therefore it adjusts for more money. But if the velocity reverts to something that's more normal historically and the money gets out, and the money will get out especially if people start fearing inflation, then we might have big spirals upwards. And the plan is for the Federal Reserve to just keeping on in the printing, and everybody sees rates low for longer, ECB also printing. And also, what will be the solution to the next crisis? Nobody's thinking that there will ever be a recession ever again, and then things happen. The next solution to slowing down economic growth will be more and more money printing, which leads to higher and higher inflation long term. And of course, then we have asset price inflation, because people are trying to protect their wealth, park their money where it will do good, no matter what happens, protecting themselves, keeping their wealth. And then people tell me there is no inflation. Look at this, the S&P 500 from 2009 went up, what is this, 430%. And if we look at it over the last 2 years, we are up 73% just in 2 years. Oh, my portfolio that I started does beat the S&P 500. Okay, I'm still doing good. So, especially look at this, from March, we have been in the worst economic year since like ever practically, and stocks are up 50%, 70, 80% since 20th March of 2020. This is asset price inflation, as people are looking for protection against the money printing, against the increase in the monetary base, against the devaluation of currencies. And now we have to also apply common sense. Wages, 3%, 5% growth. Try to find a good worker, and those who have a business will let me know in the comments if it is like that. So try to find one and see how much you need to pay him. Also on real estate, some say real estate prices now have been going up, but if you look at something that's not in the middle of nowhere, then you really see prices spiking higher and higher. And that's also something to keep in mind. Statistically, you take everything into the inflation calculation, but realistically, do you want to live in the middle of nowhere, or you want to buy something where there is more and more people? That's also something to keep in mind. So I feel that prices go up no matter what they say. 1, 2%, I'm more inclined to 3, 4, 5% per year, because that's simply what I have to give out to live equally, no matter the technological improvements. And how big inflation is and why it is so important when it comes to life finances, personal finances. If we start with the consumer price index at 1,107 years ago for the US dollar, just 40 years later, the purchasing power was already half. Then if we keep going there, just 30 years later, again half, and now we are at lower, lower, and lower. So if we start with 100 when I was born in 1983, we are now, what, 62% down in purchasing power on the measured inflation, which means that this is likely more than this. So it's a given that currencies lose value, that there is inflation, and it's something we have to keep in mind in life and with investing. And that's also why governments and central banks have a 2% inflation target, because it is there, but you don't feel it and you don't panic, and it keeps things stable, but it keeps things running. It's easier to pay debt, which means that is more attractive, more investments, more growth, more economic activity. Everybody happy if things are stable. So you will spend your money, but prices will not go up that much so that you can't plan. That's also something that in some areas, for example, for the Netherlands, things have gone out of control, for example, with real estate. So some people planned on buying a house and it's just escaping. Also in the US, I'm sure, just escaping, which means that inflation is a little bit higher than 2%, which leads to issues with planning, and that's something that governments want to keep stable, even if we already see them losing control over that. Also from the government side, the government gets 2% more each year for doing nothing. Governments have debt, which eases the debt repayments and other obligations like pensions, etc. Yes, your pension, they pay less and less in real terms every year. That's how it works. But if it's 2%, as said, you don't feel it. If there is higher inflation, it's, as said, not good because you can't really plan. And if there is the inflation, then you are not really spending because you think that prices will go lower, lower, and lower. That's like a stock market crash. Everybody is waiting for prices to start go up and nobody's buying when they go lower, similarly in the economy. And the target inflation, this is from the Central Bank of Canada, is always 2%, and they managed to keep it around 2% for 3 decades. How do they do that? With monetary policy. And monetary policy, one is interest rates. We have them now at 0. Quantitative easing, not effective anymore. Now we are at monetary policy free, helicopter money, fiscal collaboration, whatever, printing at will, and that can only last for so long. What usually happens is that printing gets out of hand because people, okay, let's print more, let's print more, let's print more, and this is my twice in a lifetime that I have lived through it. So this is, what is this? 500,000 bills. So 5,000 bills from bills that were 51 bill, and then we go higher and higher to 100, 500, and then when you try to get solutions through printing, it's simply impossible, and then you get a stack like this of worthless money. I don't know what will happen. I hope we won't see the euros that we have now and the dollars to be worthless money, but there is a big difference whether there will be inflation at 2%, 5%, perhaps just a few years. If there is 5% and you get a mortgage now with 2% fixed for 30 years, you will do a good deal. You will have a great deal. So that's something also to keep in mind and think about it. Also, businesses, well, how will my business react to possible higher inflation? I don't know what will happen. I know that things always surprise us. We had the 2009 financial crisis, we had COVID now, we had the dot-com bust in 2000, so there is always something that will surprise us. That's the nature of the game, and that's also what makes it interesting. When it comes to investing, how to invest with inflation, we have this chart from JP Morgan that I already showed in a few videos, but I want to question this because this is since 1988 and median inflation was 2.5%. And what if we see median inflation over the next 10 years at 5, 6, 7%? It's statistically, let's say, wrong to take this as a measure. Of course, equities with high and rising inflation should do better, but then the question is, okay, is this already priced in the prices? Which brings again to fundamentals, to basic investing, which is what we do on this channel. And tomorrow we'll discuss the fundamentals of all the companies in the Dow. So click that like button and subscribe if you haven't. Also, when it comes to investing, it relates to a lot of things, from valuations, from interest rates, from the economy, from currencies, from global expectations, especially from sentiment when it comes to investing. So a lot of factors weigh on prices, and you can't really predict that. Inflation can be higher, will likely be higher somewhere down the road. So my goal is just to tell you, don't be surprised if there is, don't be surprised if there isn't. It's as simple as that. One day, likely with this printing that's going on, they will lose control of the printing. It's impossible to just keep on printing and have people say, okay, we can have as much money as we want and everything is free, yay. That doesn't work, and it has never worked in history, so we'll see for how long it will last. It's impossible to predict when, but we start feeling things, and therefore we have to be protected. What I feel also possible, as we discussed in the last decade video, is a stagflation situation. So we had really 10, 12 really good years, then recession, and then printing, and then inflation gets out of control, and the stock market crashed, what is this, 50% here, 70, 80% in real terms, and then it took a while to rebound, but then things started to be better, and we had a bull market since the 1980s. I don't know whether this will be the case. I'm ready for that. You should be ready too. But this is very, very likely given the current situation. How to prepare? Well, always look at how your business can deal with inflation, with higher rates, if it gets into trouble. So some businesses will get into trouble. Insurance companies, for example, they get their premiums now, and they have to pay inflationary claims down the road, then it's not so good to be in insurance business, for example. Buffett knows that, but he is ready to take advantage of the weakness of others in the insurance business, for example, if that happens. Also, something very peculiar is, if we look at the estimations from the CBO, you see everything so stable. Inflation stable, real GDP growth stable, we'll never have a recession ever again, low net debt to GDP ratios. And this is completely insane, because I can't believe that this will be so stable forever, globally, not just in the US. So I'm always willing to be prepared for anything. And this borrowing of 3.2 trillion, just like there is no tomorrow, is something that I feel personally might not last forever. If it lasts, well, we are all rich and will be rich forever. If it doesn't, we have to be ready. So let me get some help from Warren and Charlie, discuss how businesses do in inflation. A very, very nice chat from their conference, so when they were younger, so they talk a little bit faster, so that's good. And then we'll just conclude with what I'm doing and how I see things next.
Which of Berkshire's businesses are best suited to thrive during a period of high inflation, and why? Which will suffer the most, and why?
Yeah, well, the best businesses during inflation are usually the best. They're the businesses that you buy once, and then you don't have to keep making capital investments subsequently. So you do not face the problem of continuous reinvestment involving greater and greater dollars because of inflation. That's one reason real estate in general is good during inflation. If you built your own house 55 years ago like Charlie did, or bought one 55 years ago like I did, it's a one-time outlay. Whereas if you get an inflationary expansion in replacement capital without having to replace yourself. And if you got something that's useful to someone else, it tends to be priced in terms of replacement value over time. So you really get the inflationary kick. Now, if you're in a business such as the utility business or the railroad business, it just keeps eating up more and more money, and your depreciation charges are inadequate, and you're kidding yourself as to your real economic profits. So any business with heavy capital investment tends to be a poor business to be in inflation, and often it's a poor business to be in generally. And the business where you buy something once, a brand is a wonderful thing to own during inflation. See's Candy built their brand many years ago. Now, we've had to nourish it as we've gone along, but the value of that brand increases during inflation, just as the value of really any strongly branded goods. Gillette bought the entire radio rights to the World Series in 1939. And as I remember, it cost them $100,000, and for that they got to broadcast the Yankees, I think, versus the Reds in 1939. And think of the number of impressions they made on minds in 1939 for $100,000, and they were getting into the minds of young guys like myself. I was 8 or 9, and millions of people. And they did it in those dollars then. And of course, if you were going to go out and try and have a similar impressions on millions of minds now, it costs a fortune. And part of that's due to inflation, part of it's due to other things. But it was a great investment which could be made in 1939 that paid off in terms of selling razors and blades in 1960 and 1970 and 1980 dollars. So that's the kind of business you want to own. Charlie?
Well, yeah, but if the inflation ever goes completely out of control, you have no idea how it's going to end up. If it weren't for the Weimar inflation, we might never have had Adolf Hitler. It was the twosome of the great German inflation followed by the Great Depression that brought us Hitler. And think of the price that the world paid for that one. We don't want inflation because it's good for See's candy.
No, I didn't quite realize I was
No,
proposing that.
I'm not. I was criticizing it.
What's good for See's candy is good for the United States.
Thanks, Warren, and thanks, Charlie. From my perspective, I'm looking at businesses. If inflation stays where it is, all equal, good. If inflation goes higher, even better if I have good businesses that have pricing power. And that's what I strive to achieve, to have a portfolio that's anti-fragile, that does well no matter what. Stagflation might limit the Fed's action, and all those that benefit from the Fed's action might suffer. So again, it's good to be diversified or away from the risks, or concentrated with things that will do good no matter what. That depends, of course, on your knowledge and conviction, and finding those opportunities that are low risk, high reward, which is the core of value investing. And the main message, as Buffett said, know your business well, know your businesses in your portfolio well, no matter what happens with inflation. Thanks for watching, click that like button, and I'll see you in the next video tomorrow with all the businesses of the Dow.